Joining us now are Chad Morganlander, Washington Crossing Advisor, Senior Portfolio Manager, and Jack Ablin, Cresset Capital Chief Investment Officer and Founding Partner, who joins us on the phone. Good afternoon to you both. Chad, I'll give you, just a chance to talk about how the action today in the markets, a migration away from risk, people looking to buy the bonds they sold a couple of days ago, fits into how you were already positioned and anticipating things in the market, because it seems that you probably were already leaning against the higher risk areas of the market.
That's correct, Mike. Basically, several weeks ago, we took our overweight allocation to equities down to a neutral. A couple of reasons for that: a global deceleration, in particular within China and the Eurozone. We were overweight since April, May of last year. Also, valuations were getting a little toppy with a 2023 PE multiple on the S&P close to 20. You saw high yield spreads that were very tight, financial stress indexes that were historically low, and market cap to GDP levels that were well above 1999 levels. And lastly, you saw companies that were lower quality, companies that were decreasing their dividend or cutting their dividend, eliminating them, outperforming companies that were raising their dividends. So we positioned our equity portfolio more towards high quality equities at this point within the market cycle.
Jack, today's action, do you think that it's building to some kind of a chance to kind of reload for some strength in the later part of the year, as many investors have been expecting? Or is it a bit more of a warning shot that, the market was maybe a little too stretched and not attentive enough to the risks?
Hi, Mike. Yeah, I think it's still a little too early to tell. We got this VIX spike. I think a lot of the selling is forced selling. We saw that during the early part of the lockdown in 2020. So I wouldn't read too much into this selling as a fundamental shift of what, a new way of looking at these companies necessarily. We'll have to see what VIX does, and I think if VIX settles down, which we think it will, as more information comes out, then I think we will get a chance to buy some quality companies.
But based on the information that we know now, Jack, it was enough to trigger a whole lot of selling today. What do you tell investors to do in that kind of environment where there's still so much uncertainty and so much that we don't know and some scary situations here?
Yeah, I would tend to agree. We want to stick with quality, which has really been our theme most of the year. I think we recognize that, a third of the Russell 2000 comprises companies that haven't made a profit in 5 years. So it's a bad index. We think, if we're going to delve into small cap, which I still think is still not a bad place to be, we want quality companies that, pay decent dividend.
Chad, you mentioned that you moved away from an overweight in equities relative to bonds. Do you think that bonds here present an outright value? In other words, that they can add to returns, or you would just stay neutral and assume that they're going to just act as ballast for the portfolio?
So I agree with you. I think that you need the bonds in your portfolio. We're recommending that investors do own fixed income, high quality fixed income, shy away from high yield bonds, and we would structure a bond portfolio in just a deliberate laddered portfolio, 1 to 7 years or 1 to 10 years overall. We would also shy away from beta at this point, so we would be underweight emerging markets or eliminate emerging markets from one's portfolio, as well as small caps. We would have an underweight.
Chad Morganlander, Jack Ablin, thank you both for your reaction today and some of your tips.
Thank you.